Thanks for clicking. All eyes were on Stats Canada this morning as it was set to release Canada's inflation data for the month of March. Economists were predicting a major drop in the CPI, with predictions coming in that we would see a drop from last month's 5.2% down to 4.3%. We got our answer at 8:30 this morning, and those economists were right. March's inflation rate came in at 4.3%.
Finally.
Definitely, there is some good news in this report, but when we look closer at the data, we can see a lot of what Governor Tiff Macklem was talking about last week, when he said that it could take a long time for the inflation rate to get back to 2%. So what I want to do today is go over March's inflation data, take a look at some of the ongoing pressures which definitely will have the Bank of Canada concerned, and then discuss what to look for next. Well, Canada's inflation data is the story of the day. Canada's banking regulator, OSFI, just released a report saying that Canada's housing market is the biggest risk to the financial system.
I am the danger.
We are going to continue to track Canada's housing market on this channel, as well as the banking system. Click like and subscribe if you want to get those updates, but for now, let's get into this data. Onto the inflation data. As mentioned, Canada's inflation rate came in at 4.3% this morning, backing the Bank of Canada's decision to maintain its pause on interest rate hikes. Gas prices were one of the main drivers of the reduction in inflation, dropping 13.8% since this time last year in the immediate aftermath of the Russian invasion of Ukraine. Food inflation also dropped down to 9.7%, down from February's 10.6%.
We're going to win this thing.
In core inflation, which strips out more volatile items like food and gas, and the measure of inflation which the Bank of Canada looks to when it's deciding whether or not to raise interest rates, that dropped in March as well, with CPI median falling from 4.9 to 4.6, and CPI trim moving from 4.8 to 4.4. If we take out food, gas, and mortgage interest costs, which for obvious reasons have risen substantially since this point in time last year, then the CPI moves down to 3.6%. And if we remove everything besides clothing and footwear, then inflation drops down to 2.4%, and the Bank of Canada's job is finished.
Don't get any ideas.
So, for the most part, we do have a lot of good news coming out of the CPI this month. And, all else being equal, it's likely that we're going to continue to see good news well into the summer, as base year effects continue to set in. When we talk about inflation, we're talking about year-over-year inflation. So, when we look at prices in March of 2023, we're talking about how much those prices have increased since March of 2022. So when we saw those big price increases leading up to our peak inflation rate of 8.1% in June of last year, we should also see big falls as things start to normalize this year. Further, if we look at a lot of the items in the CPI basket, such as household furnishing, we see that there hasn't been much movement since inflation hit its peak of 8.1% in June. So, all else being equal, so long as we don't see any major exogenous shocks to the system, like a major spike in gas prices, we should see Canada's inflation rate continue its downward path for the next couple of months. However, that doesn't mean we're out of the woods just yet. While service price inflation did drop down to 5.1% in March, a 5.1% increase since this point in time last year, we did see a 0.5% increase from this point in time last month. And if we look at service price growth at the peak of Canada's inflation rate in June of last year, we can see that price growth has already gone up by 3% in its only March. Food is already up 7% since Canada hit its peak, and again, it's only March. So, we do have certain segments of the CPI basket, such as food, such as services, such as wage growth, which we'll get to in a second, which are not going to be subject to the base year effects that are currently responsible for the major reduction that we're seeing in the CPI. And add to that are the 155,000 government workers which are set to go on strike tomorrow if they don't receive their 4.5% annual raise.
You're getting one way or the other.
And it's not just them. Expect to see more and more of these wage demands, more and more of these potential strikes going forward, as workers, both in the public and the private sector, try to recoup some of their lost buying power that we've seen since inflation started to rear its head in 2021. So, because of base effects, Canada is seeing a major reduction in its inflation rate, down to 4.3%, and, all else being equal, it should continue its downward trajectory well into the summer. With that said, we are starting to see some of the lagging indicators that the Bank of Canada governor was discussing last week, when he said that although getting the inflation rate down to 3% may happen over the next couple of months, getting it down to that 2% target is a whole different story. As wage inflation kicks in, as food continues to go up, as workers try to recoup some of that lost buying power, that is going to make its way into the inflation rate. Not to mention, with the Fed raising rates in the Canadian dollar much lower than that of the US dollar, there is always the potential for us to import inflation from the United States. Further, by many accounts, the real estate market is kicking back into drive again, and while it's not clear that we're heading back to pandemic level pricing, those base effects that we talked about today will also be the case for real estate tomorrow. If real estate shoots back up, that's going to show up in the CPI data as well. With that said, whether or not Canada's inflation rate will in fact get back down to that 3% by summer remains to be seen, but we'll obviously continue to track it on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.